All right, welcome to episode 2 of the 80/20 Rockstars podcast. We've just rebranded. It's not called the Real Estate Boss Podcast anymore. Very excited. Now we're going to be on Podbean, iTunes, YouTube, all that. So check the description below to find out and listen to it however you want to listen to it. Today I've got a very interesting guest. His name's Jared Pontz. He runs and manages a direct mortgage loan company and Alphon Pontz Properties. It's a very successful, the company's about a little more than 15 years old.
So I've been in the business for 15 years. The company is 65 years old.
So the company's 65 years old. Jared has been with the business, as a partner for about 10 years, business total for about 15 years. They're right up on Germantown Avenue. They are a soft, hard money lender, and they're very good at what they do. They've got about $50 million in hard money loans, receivables-ish out there.
Money outstanding, yeah.
Money outstanding out there. So they're a very successful lender that lends on basically residential, commercial real estate projects in and around the Philadelphia area, correct? So, and Jared's the mastermind behind the scenes, so I think it's going to be very valuable, some of the things he's going to share today. So thanks for being on our show.
My pleasure. Thanks for having me.
So, how did you tell me a little bit about yourself before we get into the business.
Yeah, sure. So I got into business about 15 years ago. I actually met my current business partner. My current business partner's name is Bob Elfan, local real estate broker, owns one of the largest, if not the largest, independent brokerage in the city. Also at the time owned a smallish property management company and a smallish private lending company.
All right.
And I interned with him out of college for about a year. Basically sat across the desk from ran some errands, made $10 an hour cash under the table, and sat across the table and just listened to those conversations, became friends with him. He gained his trust, that sort of thing. And during that year, it was always known I was going to go off to the United States Peace Corps. I served in the Peace Corps for 2.5 years, just under 2.5 years. And during that time, I kept in touch with Bob. And at some point or another, we started talking about what I was going to do when the Peace Corps was over. And he said, come back, work for me. I'll pay you, whatever he paid me at the time. It wasn't much. And see if there's a place here for you. And so I came back and worked for Bob. One thing led to another. I ended up, after a year, I moved from kind of an assistant role to general management role I moved from an assistant role to a rental agent role. Okay. I did some rentals, and from the rental agent role, I moved to a general manager role where I managed a couple hundred units. And then after a little bit of time doing that, I gravitated towards doing some of the lending business. Okay. And then one thing led to another, and after about 3 years, I was pretty much running the day-to-day of both of his property management business, not as a partner, as an employee, his property management business and his private lending business. Both businesses were respectable sized businesses, but much smaller than they are now. The private lending business, direct mortgage loan company, at the time had $3 or $4 million in receivables, a fairly small company.
2005?
This was, 2005-ish is when I started. 2007, 2008 is kind of when I got to the point where I was kind of running the day-to-day operations with his oversight. I mean, he made all the final decisions at this point. Okay. But I was doing the heavy lifting, going to him with information, running things by him, really just learning. He mentored me, he coached me, he taught me the business, both the real estate side of the business, how to buy properties, how to analyze properties, how to manage properties, how to deal with tenants, how to deal with repairs and maintenance, you name it. He taught it. We had a team, but he was the ringleader.
Right. And still making most of the decisions.
And then on the private lending business, we were actually pretty big back then in taxi cab medallion loans.
Really?
And a huge piece of our business was lending taxi cab medallions, and a much smaller piece, frankly, was real estate. And for one reason or another, we got out of the taxi cab medallion business.
I did not know that.
Yeah.
Because aren't they like $300,000 or $400,000?
They were until Uber and Lyft came around, and now they're basically you can't give them away.
Right.
A lot of the people that bought them for $300,000-$400,000 are reorganizing and restructuring with the banks and their lenders now. So it's in a very serendipitous way, we got out at the right time.
Yeah.
We didn't want to get out at that time. It became a very bankable business, and so mainstream lenders got into it, and so private lenders like us were kind of pushed out. And so we kind of refocused into real estate, slowly built that. And around 2008, I had decided I wanted to go back to business school full time, and then I wanted to kind of move on with my career and my life. So I approached Bob, very hard conversation. We talked about that. one thing led to another, and he said, I don't want you to go. I see you as my succession plan, and kind of, like I said, one thing led to another, and he offered me a small piece of the company, and we negotiated for a while, and one thing led to another again, and we became partners. I was a very, very junior partner on a very small piece of the company, but with the promise that he would stand behind. We made the deal saying, I want to grow this. I think there's something here. This lending business could be something. There's a market for this in the city, and I want to do more real estate development. He said, I'll support you. You don't need me to hold your hand. Go do what you need to do. I'll support you. I'll help I'll be a financial backing, support, help grow the company, all that sort of stuff. And we ran with it. And we started right around 2009. We started buying real estate together and developing it. We started flipping a couple houses. Then we went to a couple, 3 or 4 unit mixed use properties. And now we're doing mostly apartment buildings. And we don't we're not a volume developer or investor. We, maybe a couple of deals a year, that sort of thing.
Okay.
And then at the same time, we've refocused on the mortgage company. Went out and increased our lending capacity, hired some good people, kind of streamlined our internal processes. And I hit the pavement and started trying to meet as many people as I could meet, networking, getting referrals, walking around neighborhoods and knocking on properties. And literally we go drive down to South Philadelphia and with little flyers and hand them to people, and I'd go to a job and I'd see another construction thing down the block and I'd walk down there and say, hey, is the owner here? And that's hard, and that is actually quite less successful than succeeding with one person and saying, hey, if you're happy with me, tell your friends. And that's really the best way. And so one thing led to another, we really grew our business, and we went from a $3 or $4 million receivable company, and we have 50 million, just under 50 million right now on the street.
Which is a lot, and that's mostly by referral.
It's both. It's a combination of referrals, just kind of word of mouth out there, not even referral, just people talking. We work hard to get our signage out on the properties, so people see that. We have really strong SEO. So we get a lot of leads through our website, and actually I'm always flabbergasted by how many leads we get through our website, and quality leads, and cold calling. I mean, I still to this day, I spent my week last week cold calling
for new business,
but people I knew were out there doing it. I'm not like randomly calling somebody not knowing, but I'll say, okay, I'll identify 10 people, and I'll say, these are guys that are out there, they're borrowing from somebody, why can't it be me, that sort of thing. And I just cold call them or cold email them, and if they ignore me, they ignore me. Sometimes they get rude responses because I'm hard money and people don't necessarily respect it, and it comes with the territory, and I try to explain it. And so anyway, here I am.
Nice.
That's kind of the down and dirty abbreviated version.
Okay. Yeah. So what exactly is hard money? I know you guys are slightly different from your typical hard money lenders. Like, what do you guys do a little bit differently? And what's helped you separate yourself from a lot of other people? Yeah,
so, hard money, I always have thought of hard money as kind of asset-based lending. It's where the lender is a little less concerned about the credit or the income and the financials, and a little bit more focused on the asset value of the real estate. That's not to say they're not also looking at those other factors, but I think the number one decision maker is oftentimes loan to value. Where we've always differentiated ourselves, and where I've kind of sold ourselves from day one, was that we're a little different. We've always thought of ourselves as, I term soft hard money, and we call ourselves a soft hard money lender. And I've always said that we're the good guys in the business, not that everyone else is bad, but it's a shark world kind of thing. And so we're very transparent. We're in different areas of real estate, so people can research us and look us up and know that we're legitimate and know that we're out there. And we have a reputation because my business partner is also associated with Elkhart Wisconsin Realtors. And so people kind of know us from that way, so that gives us some instant credibility, which has really helped. And also we've got a track record at this point, so people can Google us and look us up, and they can see articles about us, they can see testimonials, they can see deals we funded, they can read. With the internet, they can do that on anybody, but particularly we've worked hard to kind of get that out there so that people can see it and know it's there, and it puts people at ease in that way. And so we've worked really hard to differentiate ourselves by just hustling. People always say, what differentiates you? And I say, I'm a hustler. And so I'll out hustle anybody. At least that's how I think of myself, right? Whether that's true or not, I'm not the one to decide, but I think that I'll out hustle anybody.
And belief that operate.
Right. We'll chase down any lead, we'll chase down any deal,
right.
And we'll communicate. So I'm getting back to people, and my team's getting back to people instantly. You're not going to have 3-day wait to get an email response. You're not going to get a 6-hour wait to get an email response. I want those emails responded to quickly, and I want phone calls responded to same day.
Right.
That did really. I mean, it's shocking out there how many people don't respond to emails, don't respond to calls, or are have big gaps in time. And it always shocks me how people can be successul with such gaps in time in that sort of thing. And so I pride myself, and I pride my team's pride myself on my communication and my team's communication.
Right.
And
that's huge.
And so that differentiates us as well. And then we know the business. So we know the local real estate market, we know the surrounding marketplaces. And so we come to it with knowledge, not relying on third-party appraisals to tell us what's what. Mm-hmm. So people can call us up, run deals by us once we have a relationship, ask us questions, ask for feedback. Hey, what do you think about this deal? What do you think about this neighborhood? These are my numbers. Do you think it's a good scenario for me?
Yeah.
And because we know the market and because we understand real estate, right? We're doing larger deals ourselves, deals that we're not funding, but we understand the ins and outs of the construction. We understand how deals get structured. We understand how the developer or investor is looking at the deal out of their eyes. So when I have that conversation, you're not talking to a suit and tie who's like, it's like talking to a wall sometimes. And
they're just looking at an Excel spreadsheet. And
correct. When you're talking to a banker a lot of times, right, they're just gathering the information. It's like you're just talking to yourself. They're like, okay, just send me the email with the information. Because they don't really know what to say to you. They don't really know how to engage with you. They don't know what questions necessary. Yeah, some do, some don't. They don't necessarily know the questions. I want to capture that conversation. So if you call me up, I'm not saying, hey, email it to me. I'm going to say, I'm going to eventually say email it all to me so I have it in, some sort of record of it.
Sure.
But I'm going to take that opportunity to engage you in that conversation and start asking questions. What are you paying? What's the rehab amount? Are there structural issues? Is there a need for an environmental? What's the after repair value? What's the block like? Are the shells on the block? What's the next block over like? Where are the comps being drawn from? Is there other development in the area? Is this a single family market? Is this a rental market? Is this a flip market? And we're going to start engaging that sort of conversation. And I don't need to do that with a lot of my clients. A lot of my clients come to me with, they know exactly what the deal is, and they lay it out for me really nicely, and we don't have to go there. But there's some people who really appreciate that knowledge and that base.
Super valuable.
And we bring that to the table. We've got good technology. We've got professional mortgage software. We have a really well-organized origination software system.
And now you can pay your payments online too. It's another thing. Want to throw it out there?
Yeah, sure.
I have loans with them, and now I can pay payments online. I'm very excited about that.
So you can make payments online. You can also review your account history online. You can go into our website and we will set you up, and you can log in and you can view all your loans, not just the current one. You can your whole history of loans, and you can view your payment history, if you have late fees, how the interest is calculated, what the original loan balance is, what the current loan balance is, whatever you want. It's all there. So
you've got the whole system pretty much figured out. And I'll jump in and say something here. Like what you covered a lot right there. Like I originally met Jared through actually Jim referred me to you. So I met Jared through referral, and he's not the type of guy who's just gonna, like you said, in fact, you meet everybody in person, like you said. Yep. You're actually gonna sit down with them and have a conversation, and he's gonna make sure that what he's doing is gonna help you get to where you're gonna go, because otherwise you might do one deal and then you make money, but the person might not make money, and then maybe they're out of business. Right. So super valuable, and it's just the speed of it really does make a difference. Even though you pay a little bit more in interest, at the end of the day, the speed and ease of working with you guys is a huge factor. Like I've called him sometime. I think the last loan we did, I might have called you. I thought I had maybe another lender lined up. Called him 9 days before closing when we had already been under contract for like 3 weeks. I'm like, oh my God, I messed up. I need this money in 9 days. This is the plan, and he gets it done. So it's really, really big to have, once you build a relationship, to be able to have that kind of service can make or break you getting a deal in the first place. So
right. So I use the term ease of capital a lot. Right. We try to make the process as easy as possible at every step.
Sure.
So, the initial intake of the lead, right? The initial contact, the application process. We, like you said, we meet and interview every single person we lend money to the first time.
Yeah.
We may never see them again after that. 50 loans later, we've never seen them.
Yeah.
We're talking. I'm exaggerating, but we're seeing people obviously. But it's about that initial interview and kind of the smell test, right? At the loan closing, the draws, the payoffs, every single step we make easy. The ease, our ability to make it easy, draws the client, intrigues the client, creates an opportunity for us to work, create a relationship. And after that first kind of scenario, we work off of relationship, right? So we do a typical loan application the first time where we run credit, we get financials, we look at experience, we want to know who we're dealing with, obviously. And then we kind of put all that information in a file and we run with it from there. And it's all relationship, right? You've probably heard me say, I don't really want to have coffee with you and you don't want to have coffee with me. You're a busy guy, you're hustling all day long. I'm a busy guy, I'm hustling all day long. Coffee every once in a while is fine, but you're not going to get constant requests for that sort of thing. What you're going to get from me when I say relationship is you're going to call me up and 9 days later you're going to close. Or on that phone call, you're going to know if you have the money. And when I say we're a relationship lender, we're really a relationship lender. Everyone says they're a relationship this, a relationship that. But when I say relationship, I mean speed. And I mean, we work based on our ability to move quickly is based on the relationship.
It means everything too, because you could be making an offer on something and need to know whether you have the money in the bank before you put a $10,000 deposit down. That's going to be hard immediately. So, let's just say someone's watching this and they're a beginner, they haven't done a hard money loan before. Maybe let's just jump into it quick. Let's say you're going to start with a house, a small house in West Philly. You're going to buy it for 30 grand. You're going to put 60 grand into it. Say $65,000 in it. It's going to be worth, I don't know, 150. You're going to start with a little rental that's a standard or a flip, whatever it is. What kind of terms are generally are you giving them half the money to buy it in all the rehab, a third? What general terms are most people working off of?
Yeah, the exact deal structure depends on the client, depends on kind of the credit risk and that sort of thing. Kind of the standard deal, the starting point, we'll do 75% loan to value on acquisition.
Okay.
We'll do 100% of whatever the rehab dollars are.
All right.
As long as total loan is not more than 70% of after repair value.
Got it.
So we lend based on after repair value, particularly on rehab loans and construction loans. And that frankly allows us to lend more money than kind of the typical loan to cost structure.
Right.
A bank or a lot of other private lenders are doing 75, 85 loan to cost. And so that requires a lot of money being put into the deal. And so we'll do a 7% after repair value, which is, you still have to have some money in the deal, but a lot less in most instances. And it still gives us the buffer and the comfort of knowing because we're doing draws on those sorts of loans, and so we're staying ahead of the developer. Kind of our typical, as we sit here now, our typical interest rate is 11%. That's kind of on the relationship, good relationships, lower credit risk, that sort of thing. And we charge a placement fee of anywhere 3 to 4 points depending on the credit risk and the relationship. Kind of our best clients are 11 and 3 right now. We have no third-party appraisals on deals under $500,000,
which is a very big deal.
Yeah, it's a huge deal.
He does not need to call an appraiser, and that's a sticking point in the middle of a lot of hard money.
Right.
A lot of lending.
Well, I don't really know any other lender that does that, and we're able to do that. We're able to do that because we really understand the market. And we know what we're doing. So it's not like I'm looking at a property and I'm guessing. We're doing our research. We're looking at comps. We're going and inspecting the property. We have a portfolio of 4,000 investors and real estate people in and around the Philadelphia market that we can tap into. I mean, we have a network of 4,000. I'd say we probably have more like 500 to 600 people that on any given day we can look up and say, okay, this guy does a lot of business in West Philly. This guy does a lot of business in Kensington. And if we have a concern or question, we can reach out to those people, and they're willing to help us, as I have with you before.
Yeah.
Because it's a mutual benefit sort of scenario. You call us, we move quick. If I have a question about a property on a block or somewhere near an area that you just developed on, I can reach out to you and say, hey, what are your thoughts on this, and get instant feedback. And so that's a nice competitive advantage and a nice thing for us to be able to do. And so we don't, like I said, we don't no appraisal fee on deals under $500,000. Unless it's there's some sort of obsolescence or something funky about the deal that we can't figure out or comp on our own, then we'll require it. No legal fees, no document prep fees, no prepayment penalties, no interest reserve requirements.
Right.
We kind of wipe away all the extras and we say, all right, it's cut and dry. This is the rate, this is the fee.
That's it.
That's it.
And you only pay interest when you get the loan. You're only paying interest on the amount that you borrowed. Right.
Only on the amount outstanding, which is, it's probably 50-50. Hard money guys out there either charging on everything or not charging on everything.
Well, people don't even ask, and people don't know until they get to the closing table. And it's like, wait.
Well, they find out very quickly.
So it's $200,000 loan. I'm only borrowing $50 to start. Like I'm paying,
Right. And those people end up calling me for the next deal.
Yeah. So what of the, let's say, the loans that you have out there what do you see? What are most people doing? Are they building? I know there's obviously tons of development in Point Breeze, Kensington, all these areas. Is it mostly new construction, rehab, single, multi?
So our bread and butter has always been single family rehabs.
Okay.
We do more of those than anything else.
Nice.
Last year we did about 200 new loans, just more than that, about 230 new loans.
Okay.
And about 65% of those were single family rehabs. So huge percentage of single family rehabs. And that's always been our trend, and that's always been our history, and that's our bread and butter. And frankly, we're in a city of row houses. Yeah. So if it wasn't that way, I'd be concerned about my business. And then we fill in with a significant amount of new construction, both single families for sale, multifamily to refinance and hold as rentals. We do a lot of land deals where developers come to us and they borrow on land. They go and they get their entitlements, and they either borrow construction from us or they go to a bank and they get a bigger construction loan. We deal with some developers who do $5-10 million construction projects, and they'll come to us on whatever the numbers are, irrelevant, but they'll buy a piece of land somewhere and they'll need 12 or 15 months to get it entitled, get their zoning permits in place, get their community stuff, get their building permits, and then they can go to the big bank and say, hey, this is the loan, this is what we need, and the bank will do their $5 or $10 million loan, whatever it is, and we'll just do the bridge on the land.
So they'll borrow just for the acquisition and taking it through zoning and permits?
Yeah, right. So they could, most of these guys have investors and they can use the investors, and they have cash, right? But the cost, there's I guess it's Econ 101 or Stat 101 or whatever. One of the first things, one of the best things I took out of business school was that the cost of equity is always more expensive than the cost of debt.
Way more.
And so, the developers out there have a choice. They either give up LP money and forever lose a piece of their deal, or borrow at a little bit of a higher interest rate for a short period of time. And I think if you put it on paper, the majority of times it's a no-brainer to borrow at a little bit more expensive money than to give up. Now, long term, for the bigger projects, you have no choice but to bring in investors, because my money on $10 million, first of all, I would never do that deal. Second of all, nobody would want to borrow it from me at 11%.
For something that big.
Something that big, it just would drown a deal. So you have no choice but to do that ultimately. But in the short term, it's it could be wise and a smart business decision for people.
So you're talking about, like, if someone's doing that, it's more going to be like on 1 or 2 or 3 lots where that they're going to build a house. It's like there's not a lot of risk that they're not going to get the zoning and then have a loan on the land, and then what happens?
So it depends. Every scenario is different. It depends on who we're dealing with, right? So if we're doing like a single lot somewhere, usually those are by right. And so the timing is really just about building permits, because there's no zoning permit to get it. It's all by right. And so, a 16 by 70 lot, you know what's going on. And so
I didn't know you could do that, or I didn't know people actually did that. Like, it kind of makes sense, like you said, instead of giving away equity and having someone just let their money sit there while you're going through the process.
Right. And so on the bigger deals, there's usually not zoning in place, and it's usually fairly speculative. But we're doing those with more proven investors. So people that have proven they know what to do, they have it, they know how to do it, they've done it before, they have some steam behind them, meaning they have some net worth. If they needed to, they could take us out. Or I look at the deal and I say, okay, worst case scenario, how do I handle this? Who do I move this to if this person can't make it happen? And kind of, it's risk management, really. Loan to value might be a little bit more conservative. A lot of those guys come to me and they'll say, hey, I'm buying a parcel for $1 million, but I only want 500 from you. And so they know coming in to ask they don't want to not to ask for as much leverage they can possibly get.
Yeah.
Because they don't want to put all their cash into it, but they have enough cash to put a big chunk into it. So most of those guys, I rarely ever will have someone come to me on a big land deal like that and say, hey, I need
70%.
Right, I need every penny you can give me. Like when somebody usually says that, it's typically a red flag, but not always. But those scenarios, people will come to the table with more cash than somebody ordinarily would.
Okay. Are you seeing any like trends, whether it's neighborhood trends or anything in the market? Like, are people starting to, I think the market's going to shift, and I don't know which price ranges it's going to hit at what time. Like,
before I answer that, let me just finish that last thought real quick.
Sure.
So rehabs are the big piece, right? We're doing new construction, all those sorts of things, but we're also doing, it could be a gas station, it could be an apartment building rehab, it could be an industrial warehouse, it could be a restaurant. Really, any scenario you can dream of. Somebody like me, and not just me, other lenders are doing the similar thing. We have interest in, we look at them, we like them. There's pros and cons to every sort of deal. As far as trends are concerned, I've been having a lot of meetings lately where people are like, "What do you see? What's your vision of the market?"
Yeah.
I'm not an economist. I'm not some sage that can tell you what's going to happen in the market right now. I think the market's controlled, it seems like, by one person, and so every day, we read and hear about something else dramatic and crazy going on. So I'm not going to guess, but I do know that the Philly market has been strong. It was strong. I actually grew my business through the last recession. So I look at my business as being very strong when the market's strong and being very strong when the market's weak. When the market's weak, banks are scared, but there's still investors. There's still developers out there that need to do stuff.
And they have less options.
They have less options, and so they come to somebody like me. And that's how I grew my business initially. It was, the market was tanked. Lehman Brothers had fallen apart.
Yeah.
The world was falling apart.
Yeah, I think about it because it's 08.
Right, 08, 9, 10, 11, 12. Those 4 or 5 years, I dug in, and it was timing, and I had not put, it was a little bit of luck in some ways because I hadn't put a lot of loans on my books in 6 and 7 before the crash. But that's when I kind of was just by timing focused on doing it, and it was a good time for us to also learn, we think, what not to do, what loans to stay away from, and that sort of thing.
Right.
But look, ultimately there'll be a downturn. I mean, the economy historically is very cyclical, so it's a matter of when and how you manage it. And I think a lot of the lenders that are out there will fall by the wayside. A lot of the investors out there will fall by the wayside.
Yeah.
But we're in Philadelphia, and so I see Philadelphia as a fix and flip market through and through all day long. And so I think that if you focus and don't forget about the fix and flips, I have a lot of clients who start out doing small rehabs. They might do 1 at a time, 3 at a time, 7 at a time, and then they always go for the sex appeal. Eventually, everybody goes for the sex appeal, and they always want the new construction or the apartment building, and bigger. And I always caution people. I say, don't get too excited by it. The margins aren't any better. Sometimes they may be worse, and it looks pretty, but it's harder. It takes more time.
That's literally like what's happening to us right now. I'm like, man, like we're not really flipping a lot, but like it's you rehab a house or duplex and a triplex, and you make a couple $100 a month, or maybe 500, 700, 800. I'm like, if we had a 15 unit, it's maybe a little bit more time, but we can make this much more. But if the margins, is the grass really that much greener scaling up? I don't know.
Right. I mean, I think it's look, I think it's case by case. I think it's investor by investor.
Yeah.
Some people, my investment model is built on multifamily.
Ground up.
No, well, I do a lot. Yes, we do some ground up, but when I say built on, I mean the foundation of my investment portfolio is multifamily properties.
Right.
I've always gravitated towards that from day one. I just never thought I wanted the scattered site inventory where I always knew I wanted to hold properties, not to flip them.
Yeah.
And so I never wanted the type of model where I had to run around all these single family houses and deal with one person on this and one person on that.
Right.
Kind of have 200 units and 200 owners,
nice.
Sort of thing. So we build it on a multifamily model, but that works for me. But everybody's different, and there's a lot of successful people out there doing single family rentals or rehab flips, and you can pick any kind of segment of that market, and you're going to have successful people who've made it work their way doing it.
Right.
And so I don't think there's a right or wrong, but I do think that people have to think very hard about moving from rehabbing to new construction, and generally when they think about how many they want to do. Right, I think there's cautionary tale after cautionary tale of investor who is crushing it, doing 3 or 4 rehabs at a time.
Right.
And then they try to do 10, and they drown. And I'm not going to be the guy that lets them do 10. Right, I'm going to be the guy that stops them and says, hey, I'm not going to facilitate your demise.
Yeah,
right?
And then if sometimes they might call somebody else and get, but then whatever.
Right. I mean, trust me, I have that dilemma all the time, where somebody comes to me and they want to borrow money, and then they want to borrow money, and then they want to borrow money, and I have to put my hands up and say, hey, let's get a relationship, let's figure it out.
Yeah.
Maybe this is too much, and I start coaching, and they say, well, if you won't do it, I'm going to go to somebody else, and I have to make that decision. Do I want to lose the client to another lender, or do I want to manage my book wisely?
Yeah.
And so it takes a lot of discipline to just say, sorry, if you really feel that strong about it, go get another lender. But if they feel that strong about it, I'm going to pay attention really close to their portfolio, and I'm going to be a little bit more careful when they pay something off and they come back for that next deal. I'm going to want to see what their global real estate schedule looks like to really understand, what kind of choices they're making,
how leveraged they are.
Yeah, what the risk looks like, and that sort of thing.
So for somebody starting out who's trying to get into this, do you see any common mistakes people are making?
There's a lot of people out there that are, and it's a very nice piece of my business actually, that are just starting out, or have a friend that's in real estate who's going to help them get into it, understand it. And I like that sort of business when the person in that scenario comes to the table with good credit and a job that makes them good income and some savings. So I look at it like, okay, they're financially strong. They don't understand real estate necessarily, but they're smart people, and they're not going to mess up, and they're going to do what they can to maintain their credit. And so we'll take a flyer. And it's not really a flyer; it's an educated decision that person's got the financial wherewithal and the credit wherewithal to figure it out. And sometimes they have a mentor, a guy like you, who says, hey, this is my friend from childhood, or this is my cousin, or somebody who I work with at Keller Williams. They've never flipped before, but they're really good, and I'm going to help them on their first one, introducing themselves, and those have become some of my best clients long term.
Cool.
Frankly, you were in that position, if I recall, when you first came, when we first started talking. You had
Yeah.
very little hands-on. You had experience, kind of, if I recall correctly, you were very involved in projects, but not as an owner.
Yeah.
And so you were trying to figure out, take that leap of faith into ownership and investing, and you did, and you've done it very successfully.
Scary as heck.
Right. And I'm sure in your world you see this all the time, right? Like the person who comes to you and says, they can do it, I can do it, and I'm just as smart as they are. And I always say, but they're doing it, you're not. You got to do it. Do one. Step off the bridge.
Yeah.
Take that leap of faith. And once you do it once, you might not make money, you might lose a few bucks, maybe you'll make, who knows what the money will turn out to be, but you'll learn a lot, and you'll determine whether or not it's for you or not. Because it's not for everybody. Everybody thinks real estate's easy money, but it's a hard business.
It's really not. We've been going through trying to scale and do more rehabs at once, and I think what I've been learning most about myself in the past 6 months here, because we've got, aside from the OCH Pine project and all that, which we're still involved in all that, got I think maybe 5 rehabs going on right now, and it's it can get overwhelming just mentally, especially when things get delayed. And like you mentioned before, there's 15 different places in the process where you can get delayed for no reason. We had plans for 2 triplexes get delayed at L&I for 2 months. An inspector changes every 3 months, and all of a sudden he calls us out on one thing, and we have to go get an engineer, and literally we're shut down for 3 months. So you can get backed up, or you have $700,000 in loans, and all of a sudden 3 projects are behind, and you're paying $5,000 a month in interest, and it can really you go through this period before you get back to the end, and it's rented, and I refinance.
That's why you don't want to get over your skis.
Right.
And it's easy to do a project or 2 successfully. Right. I got this. And then you jump into that 3rd or that 4th or whatever the numbers are, And one thing happens and it can really mess somebody up who's making, you know, a nice living but not getting rich in their day job, and it can hurt. It can be painful. And so I mean, I think the biggest thing I see, back to your original question, is that people get too far ahead of themselves,
right?
And try to move too quickly. And so part of my job is to slow them down as best as I can, especially as it relates to us, but also mentor and coach. We do it all the time. There was a guy last week or two we've been working with for 3 or 4 months. Went through the application process. You know, he had his own business, makes a nice living, no real estate experience to speak of, other than I think he like bought a duplex, lived in a unit.
Sure. Like house hack.
Exactly. But he had all his ducks in a row. Sharp guy. And he came to us with the deal. We said, yeah, it looks great. We vetted it. And then he came to us with the second deal. And I said, all right, you know what? Let's take a look at this. It's a small deal. Let's take a look at it. It's like a $60,000 deal or something. And there were some issues with the house that concerned us a little bit. And I went back to him and said, kind of coached him out of it. And said, hey, I don't think this is the right one for you to take your second leap on. This is why. And I'm just one guy. You know, I don't know everything about everything, but I do know that I'm not going to lend you the money. And this is how I would, if I'm you, this is how I would think about it.
Right.
And he was really appreciative. And we do that a lot. We talk a lot of people out of deals.
Right.
We don't want to get into bad deals for people. And you just made a comment before. We're a relationship lender. You know, we're not in it to make a quick buck. We're in it to, we want to make money, but we want you to make money. Because if you're not making money, you're not going to come back a second time, a third time, a fourth time, a 50th time.
Right.
So it's got to be mutually beneficial. And if it's not, if I'm looking at the deal like, well, who really, you know, hey, that's his problem if he gets screwed, or it's his problem if it doesn't work out. It's his problem if the comps are off.
That's how some people operate.
Right.
Or if he messes up, I get the property.
Right.
Great.
Exactly.
Like,
Yeah. You know, you had asked earlier, kind of start out what differentiates
you guys.
And I skipped a big piece of it. You know, not only a relationship, not only are we fast, not only do we communicate really well, not only do we come to it with a lot of real estate background, we really kind of take our clients' best interest to heart, which is, I'm feeding off of this last piece of the conversation. And, you know, I know every single person we lend to. You know, we lend in and around Philadelphia, we lend all the surrounding counties, we do a little bit in South Jersey, we just did our first loan at the Jersey Shore.
Nice.
And so we're trying to expand the geography, but we really know our clients. And so we're not trying to get so big. There are other lenders out there that want to be, you know, sell off to a private equity firm one day. And so they're about building scale. And there's, you know, the loan officer, and then there's the loan committee, and then there's the CFO, and then there's the CEO, right? We're not that. And I don't aspire to be that. I'm growing, and I want to grow my company, and we have clean procedures. But I never want to get so big where we lose the feel, we lose the connection. I think there's just value, intrinsic value to that in this sort of world of real estate. And it allows us to kind of capture, you know, it sounds cheesy, capture the hearts and minds of our clients, right? Because there's an opportunity cost to borrowing from somebody like this, right? You have people out there who say, that's crazy, 11-3, or you know, or 14-4. There are other hard money lenders out at 13-3, 14-4, right? They say it's crazy. Why would I borrow money from you or that? And there's an opportunity cost, and everybody has their reasons of why. But you know, our ability to connect with the client, our ability to move extremely quickly, to cut through the bureaucracy, to understand the deals, and lots of other things that I always say you won't even know until you get into one with us. Once you do one with us, you'll know why you want to borrow from us more and more.
Right.
Our ability to do all of those things, goes on the scale when somebody's measuring their opportunity cost. Is it worth the extra money for all of these things? And the answer will be yes for many and no for many. And that is what it is, and that's like any other business out there. But I always say that there's an opportunity cost, and investors, you know, have to weigh that and make business decisions for themselves. And there's a place in the market for somebody like us that brings those values.
I mean, clearly, you can see it in your numbers.
And they're bankable. That's a big piece.
Right.
These people are bankable. So our clients are bankable. We're not doing subprime. We're not doing strictly asset based. You know, guys like you. solid credit, solid financial. They can go to the banks, and they are going to the banks, but they're filling in the gaps with us. And they may be doing 1 to 3 deals with us, 1 to 10 deals with us, or 4 to 4 deals with us.
Right.
But they're doing it with us because they're choosing to, not because they have to.
Right.
And that's a big, big differentiator between me and a kind of what I think of as a true hard money lender. Although I fit in that box and I get it, I'm hard money. I'm not running from that title. But there's some key differences.
It's just huge. And being so big, and like, who knows if they're really making more? Like, you might have higher default rates, and you have more overhead and all that. Like, I always wonder, like, the types of businesses that lend in all 50 states, and they've got that hierarchy. Like, are they really, at the end of the day, what are they really taking home? Like, how many properties are they really taking back?
Sure.
Well,
those models are based primarily on third-party appraisals, and they're national appraisal networks. So they're dialing into a call center in Minnesota, wherever it is, and that call center is saying, "Oh, you have a deal in Philadelphia. Okay, let's look at our Rolodex of Philadelphia guys. This guy." And you probably don't know the guy. You probably never met the guy. You don't know if they know what they're doing or not. Appraisers are valuable and needed piece of business. Smart people, great people. I know a lot of them.
Yeah.
But you go to 10 of them and you're going to get
10 different
numbers. And so you really have to understand how that person analyzes the deal and be comfortable with how that person analyzes the deal, in my opinion.
I mean, it's true. Like, I'll end on this quick example. Like, when I did a refi, I think it was one of the ones, either you financed the house or we just did it outright. But the second house we ever bought, 42nd Westminster, I just remember, like, we rehabbed it, and I know my numbers are good, but like, when we did the refi, we called one of those national lenders, so you'll pay higher interest they'll give you a 30-year like 7.5 instead of 5.5 or 6.5.
Yeah.
And I just remember, like, they just Rolodex the appraiser came out there and met me, and he's like, yeah, all right. He actually never even went inside the house. He took my old pictures he's like, yeah, so how's this neighborhood? He's asking me these questions, and I'm like, are you in the suburbs or something? Like, and I know our values were good, but he gave us a value higher than probably what I would have given, which was okay. But had we been over leveraged, they wouldn't know that the house really wasn't worth. Like,
right. It could have worked in the other way. It could have gone the other way where he came in, 20% under.
Right.
Where he needed to be. And
yeah.
I mean, it's pretty common. Anyone in our world sees appraisals coming in all over the map. And that's part of the business too, right? I mean, I think that's what keeps everybody honest in some way. So I think it's a very important piece to it.
Yeah.
But I always say to my clients that we'll appraise it. If we're going to an appraiser on a deal, we already think we know what the number is. We're not going to an appraisal just to say, okay, here's the deal, let's send it off. If the number comes out, great. Yeah. We're saying, okay, we already like the deal. We want to do the deal. We just want to verify it because it's a deal of this size or whatever it might be.
Right.
I always say we can figure out the value better than anybody, but that may not necessarily always be the case.
I mean, I'm sure you're accurate, probably 8, 9 times out of 10. So
yeah.
Is there any other questions that I should have asked? I think we covered basically everything. Anything else I should ask about your business that you wanted to share?
I think in general, hard money, private money can be a really valuable tool for investors out there. And I would just say to anybody out there who's watching this that is not familiar with it, go to our website, look up that Direct Mortgage Loan Company, read about it, look up other companies as well, read about it. There's a time and a place in everybody's business for it, whether it's us or some other lender. It doesn't have to be us, just in general. I think it's a business that people have negative views and thoughts on. And I think that's just because of a lack of knowledge. I think that the people out there that know and work with people like me respect it differently, think of it differently, and see it as valuable. And so I would say to anybody out there who has negative views on what I do or my industry, look it up, give it a shot, try it. I think you'll find a lot of value in it. I think you'll find that certainly I can speak for me and my company. We're good people, honest, hardworking, trying to do the right thing, and providing a service just like everybody else is providing a service.
Yeah.
And so I guess I would leave, add that to the conversation as my closing thought.
Cool. And like you said, people work with you by choice.
Right.
They have other options.
Absolutely.
So
Absolutely.
awesome. Where can people find you one more time?
Yeah, sure. www.dmlc-lending.com. Company's direct mortgage loan company. If you Google direct mortgage loan company, the website will come up. Elfan Pontz Properties is our management development company. And look us up, and lots of information out there.
Nice. All right. Cool. Well, thank you for coming in.
Thank you. Appreciate it.
It's been a good talk.
Yeah, absolutely.
And thank you guys for watching.